Hello, it's Jack here at System Trader, and in this video I'm going to talk about the all-weather, or also called all-seasons portfolio. It is a widely known portfolio for at least two reasons. The first reason is that it has a very good past performance, and the second reason is that the guy who designed that portfolio is a highly acclaimed and very well-known hedge fund manager, Ray Dalio, and he served as co-chief investment officer of Bridgewater Associates. And the portfolio was designed with the idea that it should serve well in any market conditions. Therefore, it's called the all-weather or all-seasons portfolio. From the very high perspective, it is built of 55% of bonds, 30% of stocks, and then we have 7.5% of gold and 7.5% of other commodities. And the bit problematic part is just it has over 50% bonds. But we'll touch that problem in a minute. For now, let's dive into the details of that portfolio. And here we can see on the pie chart its components. So here we have the description. So we have 18% of American stocks in the form of S&P 500 index. Then we have American small cap stocks, 3%. We have Europe, Australia and Far East stocks, 6%. Then we have emerging markets, 3%. And this is just about the stocks. Now we have bonds. 15% of 10-year government bonds, American bonds, and then we have 40% of long-term 30-year government bonds. And then we have 7.5% of S&P Goldman Sachs commodity index and 7.5% of gold. And the assumption which we will take in this simulation, where we will see how this portfolio performed in the past, we will say that we want to, every year, at the end of the year, we want to look on the portfolio and we want to put back these weights we set here into its original values. So we will just do so-called rebalancing, so once a year. And let's see how that portfolio performed. And we'll start our simulation at the end of 1969, actually from 1970 till the end of 2019. So we have a starting capital $100,000, and after 50 years time, we end up with a capital of almost nearly $9 million. The compounded annual growth rate is almost 9.4%, whereas the maximum drawdown was slightly more than 13%. If we compare it to our benchmark, which is just S&P 500, we can notice that the profit that our portfolio, Ray Dalio's portfolio, made is slightly lower than what the benchmark did, although on the long run there's a huge difference in the ending capital, although here we see 9.4 and again versus 10.5%. After 50 years, makes a huge difference here. It's 9 millions versus over 15 million. So that's how compounding works. But where we can see a huge difference between Ray Dalio's portfolio and benchmark, just purely if we would put everything 100% into S&P 500, is that the maximum drawdown here is 13%, whereas if we would put every penny into our into the stock market, we would have to go through the loss of over 50%. Also, the recovery period, so just to get to new high in portfolio, we had to wait here over 700 days, whereas with the stocks it would take us 2 times longer. And also the volatility in the portfolio is significantly lower in AllSeasons Portfolio. Here we have 8.3% versus over 16%, so it's really huge difference. Also, if we go into some other details, and here we see the monthly return table from 1970, or we can see every month for that 50 years period, and each red cell means that the return in a given month was a loss, and the green one is its profit. And we can see that most of the years indeed were on profit. Even in the 70s till the 1981, where we were in the era of rising interest rates, even then this portfolio was having quite a good period, although it's not the best time for the bonds, because the mechanism is that if interest rates are going up, then the price of the bonds is going down. And in 2008, when we had a huge economical crisis, this portfolio was really brilliant because it made almost 6% profit. And in that time, most of investments were losing money. Okay, so this is how it looks on a monthly basis. Also, we can look on the performance log, how we can see the equity line. So obviously on the logarithmic scale, it looks just brilliant. And in general, the portfolio volatility is very low, so it's very I think appropriate, or it was very appropriate for many investors. Now let's try to mimic such portfolio in the real world, and for that reason we will use ETFs. And because we will use ETFs, and because we want to see how it would really perform on the real market, we will simplify that portfolio slightly, and we will just put 5 ETFs into such portfolio. So we have TLT, long-term bonds. We have IEF here, which is a 10 years bond, government bond. Then we have gold, 7.5%. Then we have Goldman Sachs commodity index. And finally, we have stocks, VTI, which is a total American stock market. So we don't have any, let's say, exposure outside of United States if it when it comes to stocks. But let's just pretend that we want to invest into these 5 ETFs, and how then that portfolio would look like. So the history, because we are now only using the ETF quotes, allows us to go back to 2006. And with a starting $100,000 portfolio, we would have the ending capital almost $300. The compounded annual growth rate was 7.7%. And the maximum drawdown was slightly bigger than we saw in the previous simulation, over 15%. But still, if we compare it to what happened on our benchmark, which in this case is just another ETF SPY for S&P 500 index, then we would have to struggle with a much bigger maximum drawdown. And also the volatility again is very low for that portfolio. And if we go on the monthly return table, I will just analyze on the 2020 year, because we saw the previous years already. And we had a COVID-19 issue, and in March indeed the portfolio had a slight loss here over 2%, minus 2. But after that, the portfolio is performing very well, and by the end of July, the return in 2020 is over 12%, almost 13%, which is really great if we take into the account that to run such portfolio, it takes us only, I don't know, 10 minutes. Just once a year, we just want to make sure that all these weights here are in good on good levels, and just to rebalance them, and that's it. We don't have to predict or forecast anything, and it's very simple on practical basis to run it. And now, I mentioned that the problem with that portfolio is that it contains over 50%, 55% to be precise, of bonds. And this is indeed problematic because we are on the historical lowest level of the interest rates. So even at Bridgewater, they said that in terms of building a balanced strategic asset allocation, it is pretty obvious that with interest rates near zero and being held stable by central banks, bonds can provide neither return nor risk reduction. So therefore, we should be very, very cautious here that what we saw, how that portfolio really worked in the past, most likely will not just happen again in the near future, which may take even decades. Therefore, it's good to see how it worked and to inspire our investment ideas, but we should not assume that the performance we saw will really be exactly the same in the near future. So I think that that should be the conclusion of that material. Okay, thank you for your attention. I encourage you to visit my website at systemtrader.show/st, where you can grab your copy of my software, which I used in that video, and just give it a try. Happy investing.